The Nasdaq market is open, and as of this moment, Galecto Inc. GLTO is trading at $20.87 per share, marking an absolutely seismic intraday gain of $15.92, or 321.64%. This explosive move is the very definition of a biotech stock volatility spike, an event that forces everyone from the casual retail investor using a Robinhood stock trading account to the sophisticated fund manager checking their Fidelity brokerage terminal to stop and pay attention. The immediate, surface-level expectation for a move this dramatic is simple: a major, successful clinical trial readout, or perhaps a significant collaboration agreement with a much larger pharmaceutical company. But the reality is far more complex and, frankly, more indicative of a substantial strategic shift that has fundamentally changed the financial runway and corporate focus for Galecto. And this is the insight that separates the smart, self-investing individual from the crowd today. The key development, the undeniable catalyst for this astounding volume and price surge, isn't just about a single pipeline drug success, but rather a profound corporate restructuring, driven by an acquisition and a massive concurrent financing round. Galecto announced the acquisition of Damora Therapeutics, an asset-focused move that brings with it a promising portfolio of anti-mutant CALR-targeted therapies for myeloproliferative neoplasms, a type of blood cancer. Immediately following this news, the company also announced an oversubscribed private placement, raising a staggering $285 million. Let that sink in for a moment. A biotech firm that had recently been hovering near its 52-week lows, with cash reserves dwindling, has suddenly secured a financial runway expected to extend into 2029. This immediately removes the specter of a near-term capital raise or severe financial distress, which is a common and brutal risk factor in the clinical stage biotech space. The general belief about Galecto up until this morning was largely defined by its small market capitalization, its clinical stage risk profile, and the precarious nature of its existing cash position, which was only projected to fund operations into early 2026. The reality of today's announcement smashes that expectation to pieces, not only injecting almost $300 million into the balance sheet, but also pivoting the company's primary focus. This is a dramatic and unexpected pivot toward hematological cancers, led by Damora asset DMR001, a monoclonal antibody for blood cancers, shifting the spotlight away from Galecto's previous primary emphasis on fibrosis and liver diseases, particularly its galectin-3 inhibitors. This strategic and financial overhaul explains the extreme market reaction far better than a simple single drug update ever could. The sheer volume of trading associated with this price move is critical, indicating not just retail FOMO, but significant institutional re-entry and repricing of the stock based on the new financial stability and expanded pipeline. When you see a spike like this, it's a strong signal that major funds, including those managing Fidelity mutual funds or large institutional portfolios, are rapidly adjusting their valuation models. Examining the recent trading history of GLTO prior to this morning's news provides essential context for the magnitude of this jump. Over the past year, Galecto stock had experienced a brutal descent, punctuated by periods of volatile, low-volume trading and hitting a very painful 52-week low. Biotech stocks, especially those in the clinical stage, are notoriously sensitive to both clinical trial data and financial solvency concerns, and GLTO had been subjected to the worst of both worlds. We saw the stock touch a 52-week high earlier in the year, followed by successive lower lows as the market digested negative sentiment and cash burn concerns. This morning's massive upswing is thus an almost violent snapback or re-rating of the stock, where the market is no longer pricing in the high risk of immediate capital dilution or failure, but is now valuing the combined entity based on its new assets and substantially extended operational timeline. Institutional activity, which is notoriously tough to track intraday, is visibly massive here. The oversubscribed nature of the Series C non-voting convertible preferred stock offering, which was led by major names like Viking Global Investors, Venrock Healthcare Capital Partners, and Wellington Management, is a vote of confidence that instantly legitimizes the new corporate strategy and asset base. The smart online investment move here would have been to recognize the potential for a significant catalyst in a deeply oversold stock, but few could have predicted this specific multi-layered positive development. It's a classic low-float, high-impact news event amplified by a massive capital injection. Let's briefly touch on what Galecto was before today, for those who haven't been tracking this microcap biotech closely. Galecto Inc. is a clinical-stage biopharmaceutical company headquartered in Copenhagen, Denmark, and Boston, Massachusetts. Its core mission was focused on developing small molecule therapeutics to treat fibrosis, cancer, and severe inflammatory diseases. Specifically, its original focus was built on nearly 15 years of research into galectin modulators, particularly galectin-3. Key candidates included GB0139, which was previously a leading candidate for idiopathic pulmonary fibrosis, IPF, and GB1121, an oral small molecule inhibitor of galectin-3 for various oncology and liver disease indications. The company's business model relied entirely on the successful progression of these clinical candidates through trials, requiring continuous capital to fund research and development, a high-burn business model typical of early-stage biotechs. The company's financial statements in recent quarters consistently showed net losses and negative operating cash flow, which is standard for a pre-revenue biotech, but also a constant source of market anxiety. It's this financial anxiety and the lack of late-stage clinical data that kept the stock grounded, defining the market's expectation. The current news, however, clearly signals a dramatic strategic refocus, as the company is now prioritizing the acquired Damora assets, specifically DMR-001 for myeloproliferative neoplasms, while simultaneously advancing their own preclinical dual inhibitor for acute myeloid leukemia, GB3266. This new pipeline focus on hematological cancers, backed by substantial financing, creates a completely new baseline for valuation. The macroeconomic pressures and sector momentum are also playing a role, though they are secondary to the company's specific news. The broader healthcare and biotech sector often sees a flight to quality, favoring firms with de-risked pipelines and strong balance sheets. Galecto, post-financing, has achieved a strong balance sheet overnight, making it far more attractive in a general market where capital raising can be difficult. Moreover, the focus on rare and severe hematological cancers, a high-value therapeutic area, is generally seen favorably by the market, contrasting with the mixed bag of fibrosis results that characterized the previous strategy. The new lead asset, DMR-001, targeting CALR, is a highly specific approach in a competitive but lucrative space. They are essentially trading a lower risk, lower potential return profile, IPF and galectin, for a higher risk, potentially much higher return profile, novel oncology. The market's reaction suggests it strongly approves of this trade-off, especially given the new funding cushion. This is why you see such a disparity in trading today compared to the slow, relatively low-volume decline seen previously. The low number of outstanding shares also contributes to the intense volatility, as a large influx of capital or institutional buying can have an exaggerated effect on price. Looking ahead, the future outlook for Galecto is now entirely tied to the execution of this new strategic strategy and the clinical progression of the Damora portfolio. The initial filing for DMR-001, an investigational new drug submission, is expected in mid-2026, with Phase 1 clinical proof-of-concept data anticipated in 2027. These are the immediate, high-stakes catalysts. The company has essentially traded short-term financial fear for mid-term clinical execution risk. If the preclinical data translates well into humans and the Phase 1 trial for DMR-001 shows positive signals, the stock could retain a significant portion of its current gains and continue to re-rate higher. Conversely, if there are setbacks in the IND process or the Phase 1 data falls short of expectations, the current inflated stock price could suffer a significant reversal. Investors who utilize intelligent portfolio strategies often try to manage these binary outcomes, but in biotech, the results are rarely linear. Another potential catalyst is the company's own GB3266 program for AML, for which the FDA feedback was constructive, with an IND submission planned for the first quarter of 2026. Two potential high-value oncology targets advancing simultaneously. That's a completely different investment proposition than the company offered last week. Risks, naturally, are abundant. The biotechnology sector is inherently speculative, and this stock remains a high-risk proposition. The success of the Damora assets is unproven in humans, and clinical trials always carry the risk of failure, delay, or unexpected side effects. While the funding is substantial, it is not infinite, and a failure in the lead program would erase the market's confidence regardless of the cash on hand. Furthermore, the preferred stock offering, while non-voting, represents another class of equity that could complicate the capital structure down the road. It's a complex but newly fascinating narrative. Think about how this massive strategic shift would impact the way you manage a small, diversified portfolio. Would you be more inclined to use an individual brokerage account to buy a high-risk, high-reward name like this after today's news? Or would you stick to a diversified strategy with something like Fidelity ETFs? It's a key question for anyone practicing self-investing. Comment below how you would